Welcome to Auto News Talk.
Glad to be here.
So there is this massive, almost absurd contradiction playing out in the automotive world.
Oh, absolutely.
On one hand, you have one of the world's largest legacy automakers quietly preparing to fire up to 100,000 people just to survive.
Right.
But then on the other hand, that exact same company is hyping up shiny new ambient lighting and volume dials on a traditional gas-guzzling SUV.
It's wild.
So why the cognitive dissonance? It really all comes down to a fundamental collapse of the traditional business model.
Yeah, the old formula of just, stamping out metal, putting it on a lot, and making a massive upfront profit margin that is basically dead.
Exactly. And to figure out how the industry is surviving this collapse, you have to follow the money.
Always follow the money.
We are going to trace the cash flow from the panic in the corporate boardrooms straight down to the dealership floor. Because local lots are quietly turning into, Wall Street-style risk management hubs. No fluff, just the raw financial mechanics.
It is a fascinating ecosystem to map out because every level of this industry is reacting to the exact same margin squeeze. But the survival tactics look vastly different depending on whether you are an executive in Germany or a finance manager in Ohio.
Okay, let's unpack this. Starting with the global picture to show exactly why automakers are sweating. A broad industry report from Automotive World notes that the global automaker recovery is incredibly fragile.
Super fragile.
Yeah. On paper, average earnings across the top 16 automakers turned narrowly positive after a prolonged period of severe strain. But when you look closer, the actual revenue, the profit, and the production volumes are wildly mismatched.
You're not moving in sync at all.
No.
And the reason for that mismatch is the chaos in the global supply chain, coupled with intense pressure from Chinese electric vehicle manufacturers.
Right.
Automakers are actively adjusting their electric vehicle production plans based on widely varying regional demand and, honestly, incredibly complicated global tariffs. They were trying to build multi-billion-dollar supply chains for a market that just keeps changing its mind.
Though looking at the data, there's a surprising detail regarding those global supply chains. The economic impact of the Middle East conflict on auto manufacturing was notably less severe than many in the industry had originally feared.
Which is a huge relief for the manufacturers.
Yeah.
The literal shipping of parts managed to avoid the absolute worst-case scenarios, even with geopolitical tensions running incredibly high.
But looking at the whole globe is a bit deceptive, isn't it?
A little bit, yeah.
It kind of smooths out the massive existential disasters happening at individual companies. The data gives us a great snapshot of the industry's overall profit temperature, but the glaring hole is that it lacks a company-by-company breakdown. We can't see who specifically is running a fever.
To see the fever, we have to zoom in on a specific legacy giant.
Let's do it.
One specific piece covering corporate governance outlines exactly how legacy automakers are being pushed to existential extremes just to cut costs and survive. We're talking about Volkswagen. Yeah. Porsche SE, which is the holding company with 53.3% of Volkswagen's voting rights, has publicly declared that Volkswagen is at a historic crossroads.
And for anyone who follows the industry, you know that when the holding company with majority voting rights starts using terms like historic crossroads, it means they are demanding blood.
Exactly. They are fiercely pressuring management to accelerate a massive restructuring plan. Volkswagen has to fund an incredibly costly transition to software-driven electric vehicles, but their traditional cash engine is sputtering.
It's like a massive cargo ship trying to turn around in a canal while actively throwing its own crew overboard to save weight.
That is a perfect analogy. The holding company is essentially warning that any delays in restructuring will destroy Volkswagen's long-term competitive position against lower-cost rivals.
Wait, really? The corporate governance piece mentions they are considering cutting up to 100,000 jobs. That is staggering. That is double what the industry rumors were projecting. How does a legacy automaker even execute a cut that deep without triggering an absolute war with the German labor unions?
They probably can't. That is the whole existential risk. The labor unions are warning of major, unprecedented conflict if these sweeping moves proceed.
Right.
Management is caught between shareholder survival and complete labor gridlock.
So what does this actually look like in practice? The analysis outlines the pressure, but what is the finalized structural blueprint of one of the world's largest companies going to look like once the policymakers and unions dig in and fight?
And that is the ultimate blind spot. What this doesn't answer is what the finalized restructuring plan will actually look like once German policymakers and labor unions fully engage in the fight.
They are demanding cost reductions, but the mechanics of drawing that blood are completely up in the air.
Absolutely.
So if the automakers at the corporate level are bleeding, let's look at the front lines, the dealerships.
Right, the local lots.
If corporate can't figure out their margins, how is your local dealer surviving the squeeze?
What's fascinating here is that the dealership survival tactic has fundamentally shifted away from the front-end sale of the car. An analysis based on Presidio NCM benchmark data reveals that the golden era of pandemic supply shortages, where dealers could charge massive markups, is completely over. Net pre-tax dealership profits dropped 11.2%.
Because consumers are tapped out.
Exactly.
Nobody is paying 10 grand over sticker for a crossover anymore. Pricing transparency and high borrowing costs mean gross profit on both new and used vehicles is falling fast.
Right. And here's the defining statistic of this entire retail shift. According to the Presidio data, the front-end gross profit per new vehicle fell to $1,781.
Okay.
But at the same time, the average finance and insurance income, the F&I, rose 7.1% to hit $1,727.
Wait, so the back-end finance profit is virtually identical to the profit of the physical car? Yeah. They are making as much money on the loan structure as the metal itself.
It is a profound shift. Dealerships are pivoting to a concept called payment architecture, building the deal around the customer's budget from the very beginning, rather than tacking on products at the end.
Payment architecture. That sounds like playing financial Tetris with a buyer's wallet.
That is the absolute best way to visualize it. Think about how a traditional car sale used to work. You negotiate the price of the car, and then at the very end, the finance guy tries to tack on an extended warranty.
Right.
Payment architecture reverses that entirely. A customer walks in and says, I have a maximum budget of $500 a month. That $500 is the shape of their Tetris piece.
So the finance manager has to figure out how to cram the car, the interest, and the profit into that exact shape.
Precisely. They aren't really focused on the metal. They are looking at a screen, stretching the loan term from 60 to 72 to 84 months. They are tweaking the interest rate, adjusting the trade-in value, and specifically slotting in high-margin gap insurance or service contracts until the math perfectly fits that $500 slot.
They are reverse engineering the deal from the very beginning. They manage the math because the metal isn't making enough money. But how sustainable is that? You can only stretch a loan so far before the asset depreciates faster than the payments.
Exactly.
If front-end margins keep dropping, can F&I and fixed operations, the parts and service centers, actually generate enough cash to carry the entire overhead of the business?
And that is the glaring vulnerability in the Presidio data. What this data doesn't answer is whether F&I and fixed operations can sustainably offset weaker vehicle sale profits over the long run if front-end margins keep dropping.
Which means dealerships can't just operate like local family businesses anymore. If your entire survival relies on financial Tetris, these dealerships have to scale up and aggressively eliminate risks just to keep the lights on. Here's where it gets really interesting. Dealerships are basically becoming financial services and risk management hubs that just happen to have cars parked out front.
That is exactly what they're doing. A summary of dealership strategy briefings points out that the real focus for auto retailers isn't consumer vehicle news or horsepower at all.
No.
It is hardcore operational risk and massive industry consolidation. Dealership buy-sells, meaning mergers and acquisitions, are a central theme as the industry consolidates.
Wait, I want to push back on something in those briefings. The summary says dealerships are zeroing in on major profit risks like cyber threats, organized fraud, and severe weather events.
Yes.
I understand being worried about a hailstorm denting inventory, but prioritizing cybersecurity over selling cars. That sounds like a massive exaggeration. How does a hacker even threaten a local car lot?
Because of the financial Tetris we just talked about.
Yeah.
If a dealership is basically a localized financial hub, an FI manager is running dozens of digital credit applications, pinging external banks, and managing highly sensitive compliance documents.
Oh, I see.
If a cyber attack hits their network, it freezes the entire digital pipeline. The dealership physically cannot process loans.
And if they can't process loans, they can't move metal.
Exactly.
Yeah.
A single breach can wipe out a dealership's fragile profit margin for an entire reporting period. And to maintain that complex compliance, you need highly trained staff.
Right.
The briefings highlight that high turnover in sales, service, and F&I roles remains a massive, costly issue. You cannot afford to have a rookie making mathematical mistakes in the finance office.
And the dealers know how little room for error they have with the consumer. The briefings include a temp check survey that gathered specific feedback from 483 distinct dealership rooftops. It specifically looked at leads and underwater deals, highlighting the incredibly widespread nature of the affordability crisis.
When they talk about underwater deals, they mean negative equity. A customer walks in owing $30,000 on a trade-in that is only worth $20,000. The dealer has to somehow swallow that $10,000 gap inside the new payment architecture. The dealers are highly aware that the consumer is completely tapped out.
But reading through these strategy briefings, you notice a massive execution gap. Recognizing a cyber threat or an affordability crisis across hundreds of consolidated rooftops is one thing. Successfully neutralizing it is another.
For sure.
The documents outline the fear, but what this overview doesn't answer is exactly how these dealerships are successfully closing their complex compliance and cyber gaps in practice.
It is much easier to identify a risk in a boardroom than it is to fix it on a showroom floor.
So we have automakers threatening mass layoffs to fund an electric transition. We have dealerships becoming a massive, consolidated financial hubs doing loan gymnastics just to survive. After all of that macroeconomic turmoil, what is actually rolling off the assembly line? What is the physical product enticing the consumer?
You would think it would be a revolutionary, highly affordable electric vehicle to solve the market crisis.
Right, that would make sense.
But looking at product release details from Volkswagen, we see a fascinating product paradox. Despite all the macro turmoil and the intense electric vehicle pressure from holding companies, legacy automakers are still relying on heavily updated traditional combustion engine SUVs to generate their essential cash flow.
The gas-powered SUV is still the absolute lifeline.
Unquestionably. Volkswagen is updating their midsize two-row Atlas Cross Sport. It is built on the MQB Evo architecture and features a revised EV05 turbocharged 2-liter engine making 282 horsepower.
Okay.
That is an increase of 13 horsepower over the outgoing model.
So why should an Auto News Talk listener care about a basic 13 horsepower bump on a gas engine when the company is allegedly pivoting to software-driven EVs?
Because the gas-powered SUV is the cash bridge.
Ah.
The MQB Evo architecture is a shared platform used across dozens of models globally to save billions in research and development. They are smoothing out the exterior design with a squared-off hood, stacked daytime running lights, and a flush tailgate to make it look premium.
Right.
But the real strategy is inside the cabin. They are pushing the technology angle hard without changing the propulsion. The interior boasts massive screens up to 15 inches and moves the gear selector to the steering column to open up physical space.
And let's talk about why they do that. They aren't just adding 15-inch screens to look futuristic.
Oh, no.
Huge digital slabs are significantly cheaper to manufacture, source, and install than complex analog dials, physical buttons, and wiring harnesses. It is a margin play disguised as a premium tech upgrade. It increases that front-end profit they so desperately need.
And they cleverly distract from the cost-cutting. The product release highlights a new driver experience dial in the center console.
A dial.
Yeah, it primarily controls the audio volume, but it can temporarily switch over to adjust the vehicle's drive modes or the ambient lighting before automatically reverting back to volume control.
It is a literal shiny object. They are packing a traditional gas-powered car with cheap screens and mood lighting dials to keep it highly profitable.
Because they have to. Automakers must keep their legacy combustion products fresh to fund the chaotic, staggeringly expensive corporate restructurings we discussed earlier. The Atlas Cross Sport is the cash engine paying for the electric future.
But even with all the shiny updates, there is a massive piece of the puzzle missing for the consumer. What the release doesn't answer yet are the official EPA fuel economy ratings or the final pricing structure.
Exactly.
And as we just established, if that final price doesn't fit into the dealership's fragile payment architecture, it doesn't matter how cool the volume dial is, the math equation falls apart and the car won't sell.
If we connect this to the bigger picture and step back to look at this entire journey from the corporate boardroom to the driver's seat, a few massive themes really lock into place.
So what does this all mean? If we connect all this evidence, 3 clear themes emerge. First, the margin squeeze is universal. The broad macro report from Automotive World showing a highly uneven global recovery, paired directly with the Presidio benchmark data showing front-end dealership profits dropping, proves that traditional vehicle margins are compressing at every single level of the business.
Yep.
Everyone is making less money just selling the metal.
Which leads to the second theme, financial engineering over metal. Survival depends heavily on F&I, complex loan structuring, and institutional risk management.
Right.
The Presidio dealership data and the dealer strategy briefings make it undeniable. You are not buying a car, you are buying a financial product.
And the third theme is the icy bridge. Legacy internal combustion engine vehicles remain the vital, beating financial lifeline.
Yes. The intense pressure from Porsche SE to cut costs and transition to EVs is entirely dependent on vehicles like the updated gas-powered Atlas Cross Sport to actually generate the capital required to survive the transition.
But the tensions here are pulling the industry in opposite directions. You have the automakers' goals completely clashing with the dealers' realities.
For sure.
The global OEMs want high production volume to appease their shareholders and show growth, as we saw in the macro report. But the dealers, as shown in the Presidio data and the strategy briefings, desperately want managed, limited inventory to maintain affordability and protect their fragile F&I profitability.
Right, they need scarcity.
If the automaker floods the lot with cars, the dealer loses their leverage to build that payment architecture.
And the second tension is the most jarring. The corporate crisis versus the shiny product. It is profound cognitive dissonance.
Oh, absolutely.
You have a legacy brand in Volkswagen openly threatening up to 100,000 job cuts in a historic boardroom crisis, while simultaneously hyping up a new volume control dial and ambient lighting on a gas-powered SUV to lure consumers into a dealership.
It feels like two different realities operating at the exact same time. But for you, the listener, navigating this auto market, there is one major practical takeaway.
The sticker price of the car matters less than ever before.
Exactly.
The total payment architecture, the loan term, the interest rate, the trade-in equity, and the F&I add-ons structured by the finance manager, that is where the real financial battlefield lies. That is where your money is actually being made or lost.
You really have to do the math before you ever hand over your license to the sales guy. Well, that wraps up this segment for Auto News Talk.
It's been great.
The next time you walk into a dealership, remember, you might think you're there to buy a car, but they are there to sell you a financial structure. Keep an eye on how these legacy brands balance their shiny showroom updates against the brutal cost-cutting happening in their boardrooms. Will the consumer eventually notice the cracks in the foundation? Thanks for listening, and keep asking the hard questions.